Okay, folks, today I want to talk about an article that appeared on the front page of the Wall Street Journal. This is the Wall Street Journal of March 10th, 2025. Okay, the headline is Wary Investors Play Defense and Switch to Dividend Stocks. Okay, why is this important? It's because what have I always said when you invest in your long term portfolio, right? For me, I always invested in a S&P 500 index fund, but also I reinvested dividends, right? So what is happening now? So now we have an issue where we have a lot of uncertainty in the market with tariffs. The market had run up really big after the election, and now some profit taking is in play. Now, am I recommending that you try to time the market now? No, I never recommend timing the market. I always stay invested. Um, Throughout my last 35 years of investing, I don't time the market in my long term portfolio. Okay. So this is a piece written by Hannah Erin Lang in the Wall Street Journal. Stock investors go on defense and switch to dividend stocks. And she writes Coca Cola is a dividend stock that has posted a double-digit percentage gain this year. Rattled by the threat of trade restrictions and a slowing economy, some investors are turning to a classic defensive play, dividend stocks. She goes on to write, dividend payers are just one of the safety plays gaining popularity on Wall Street. Investors have flocked to other havens such as gold and U.S. Treasuries, while fleeing stocks in smaller companies or the financial sector that could be sensitive to an economic slowdown. But many prefer dividend stocks to such alternatives because holding stocks allows investors to capture the gains if share prices rise, while the regular dividend payments help cushion declines. She continues, dividend stocks aren't risk-free, of course. Share prices can still post big swings when the markets slide or a given company runs into problems. You've seen this. Um, when the entire market is trading off, it everything gets sold, right? It happens. It doesn't mean that people are souring on certain companies. It's just that's just what the market is doing that day. People are closing positions. They're selling. But then what do? They reload at some point and start buying again. She continues, in addition, the broader equity market's rise to record territory before the recent downturn has made high dividend yields from major U.S. companies harder to find. The S&P 500's dividend yield sat at around 1.3% as of Thursday's market close, among the lowest levels in more than 20 years. So what she's saying is because as the price of stocks rise, if the dividend stays the same, then the yield is reduced, right? If you have to pay $100 to buy a stock that's paying a 2% dividend, right? If that stock rises to 120, right? Your dividend yield goes down. Okay? When the stock price falls and the dividend stays the same, right? You're investing less money to get the same dividend as someone paid more for that dividend, right? And one thing I'll note here, you might be thinking, well, hell, I'll just buy the stocks that have the highest dividend. I would not advise you to do that, right? Because when a stock's dividend yield is unusually high, what does that mean? That means the stock price is unusually low. Why is the stock price unusually low? Do people know something that the broader investing public does not know? There are people out there who analyze companies, these equity analysts, right? They make recommendations. They're constantly analyze companies. If they believe that a company's dividend is not sustainable, they sell the stock, which means the price of the stock goes down, even though the dividend is the same, means the yield on that stock goes up. And that could be an indication of danger ahead when a stock's when a stock's dividend yield is too high. Now, how do you know if a stock's dividend yield is too high? This is why I'm talking about investing in an index fund or an ETF, because you don't have to sit here and try and analyze companies. Do you know how to analyze a company? Do you know how to analyze whether a dividend is in trouble or not? Where a company's not going to be able to pay their dividend? Companies cut their dividends all the time. What happens to the price? It gets crushed. So you have to be very careful. And I'm going to be posting a video in the near future on how to know if your dividend is safe for people who are investing in individual companies. Now, I don't recommend that, but hey, you might say, Uncle Pete, if I didn't invest in Nvidia and Tesla and Amazon, those individual companies, I would miss out on all these 100, 200, 300, 500,000% rise in the stock. Yeah, you would. But if you own the S&P 500 index or ETF, index mutual fund or ETF, you would own those companies anyway. Would you get those meteoric rises? No, but you're taking a chance when you do that. You want to sleep at night, right? Look at these stocks now. Look at stock just a few weeks ago, Palantir, everybody loved it. It was traded all the way up to I think $120 a share. What is it now? It's 75 bucks in just a few short weeks. The other reason I don't like to buy individual stocks, especially tech stocks. Why? Why don't I like to buy them individually? That I'd rather hold them in an index fund with 500 other companies. Yeah, I want to sleep at night, right? But why else? Well, the other reason is a lot of these high flying tech stocks don't pay a dividend. That's number one. But also, they're traded by traders. Traders, day traders, swing traders, they love trading the crap out of these technology stocks. Palantir, Tesla, Amazon, Google, Nvidia, Broadcom, all those stocks. They're traded all day long by day traders, and it causes all kinds of crazy swings in their stock price. Are traders uh, trading Clorox? Clorox is a great company. They're part of the dividend aristocrats, which I'm going to talk about in a little bit. Are day traders day trading Clorox? No. There may be a few, I don't know. But the top prop firms out there, are there traders trading Clorox all day long? No, they're trading Nvidia, Palantir, right? The Mag 7 stocks, right? So she writes, some of the largest companies in the market have lately become increasingly focused on using cash to spur growth instead of distributing it to shareholders. That's true, right? And she mentions this ETF here, the Schwab US Dividend Equity ETF, ticker symbol SCHD. Now let's take a look at this. And we're going to compare a few things. We're going to compare what I always talk about. when you're looking at index funds or an ETF. Expense ratio, right? And in this case, we're talking about dividends. So we want to know, what is the dividend yield of this fund, right? So let's look at the summary. So if you go to Yahoo Finance, if you want to research the companies you own in your index fund or your index ETF, you can go to Yahoo Finance. You go up in here where it says search for news, symbols, or companies. You type in the ticker symbol, you hit go, and you have on the left, you have the summary, you have news, you have a chart, you have historical data, you have the profile of that fund or ETF, right? Goes through puts and calls on the options page. Holdings, it shows you what are the major holdings of that fund or ETF. Performance and risk. So let's just look at the summary of this ETF. We see down here the yield, a nice yield, 3.5% yield, right? Here's the expense ratio, 0.06. All right, let's look at performance. Let's measure its performance. Let's look at the 10-year. Let's just concentrate on the 10-year performance. 11.3%, right? So what we have here is we have an ETF, a Schwab ETF that concentrates on companies that pay a high dividend, right? It has a low 0.06 expense ratio, right? Now I always gauge that against the Vanguard S&P 500 mutual fund or ETF, which the ETF for Vanguard is 0.03 and the mutual fund is 0.04. So for this fund, a 0.06 expense ratio is pretty damn good, right? And it has a yield of 3.5% currently, right? And a 10-year return of 11.3%. All right. Let's look at something else. Let's look at the Vanguard S&P 500 ETF, ticker symbol VOO. Right? So let's compare it. The yield is 1.23%. That's less than half of the Schwab dividend ETF. Expense ratio is 0.03, right? And let's look at the performance. The 10-year performance is 12.94% versus 11.3% in that Schwab fund, Schwab ETF, right? So this is an S&P 500 ETF with a return of 12.94%. This is the Schwab, right, dividend equity ETF with a return of 11.3%, but it has a much higher yield and a similar expense ratio. So you have to decide for yourself. Maybe you want to put your money here, or maybe you want to put some of your money in here, some of the money in a Vanguard index fund or some other index, right? Let's look at another one. Let's look at, this is the Vanguard Index 500 mutual fund, okay? So here's the yield is 1.22%. Expense ratio is over here, 0.04%. Let's look at performance. Where is the 10-year performance? Here it is, 12.94%. That's considerably higher than that Schwab fund, ETF rather, and it matches the Vanguard S&P 500 ETF. It has the same return, right? What's another one? Now this one is the S&P 500 dividend ETF. Okay. This one has a yield of 2.45%. An expense, but look at the expense ratio, 0.35%. Now that's quite a big jump from a zero point 0.4 or zero point 0.3 or I'm sorry, 0.04, 0.03 or zero point 0.06 of the other ETFs. And so all I wanted to get across to you today was to just show you a comparison between these funds and ETFs that concentrate on dividend paying stocks versus what's happening in the market today with the high tech stocks that are being sold off. And the point of this video is not to have you think, well, I got to time the market. I got to sell the tech stocks when people are selling them and move my money over a dividend. That's not what I'm saying. I'm saying is what I have done over the last 35 years is invest in an index fund, an S&P 500 index fund. You could choose an ETF. You could choose a total market ETF like the VTI, which is the Vanguard Total Stock Market Index ETF. And you could look at the expense ratio on this is 0.03% with a yield of 1.25%. And the performance, this is the total, this is like 3,000 companies. The 10-year return has been 12.31%. So I'm trying to emphasize that you have to have a long-term mindset, and you can sleep at night knowing that you're invested in boring stuff. And believe me, all those tech stocks, they're part of the S&P 500, right? They're part of it. You're going to get those returns. And if you want to throw some money at some tech stocks that you've done research on and you want to take a shot on, you think has prospects for a great future, then that's up to you. Do it. I've certainly done it. I've taken, owned individual stocks, but I've owned like Exxon and um, Walmart and Coca-Cola and AT&T. They're kind of boring. They're not high flyers, and they're not in the news every day like Palantir and Nvidia and Tesla. Me personally, I don't like owning stocks like that, no matter how well they do, because they're traded by day traders, and the volatility, they're all over the place. I don't want to go to bed at night wondering and wake up in the morning. Is my Palantir stock was trading at 115, now it's trading at 75. I don't want to go through that. So I never really invested in individual stocks. I invested in, they weren't real high tech companies. Just the way it was. All right, that's it for today. This is Uncle Pete. This has been Uncle Pete's Wall Street. I'll see you in the next video. I'm going to do a video on a companion video on this, on how do you know that your dividend is safe. I'm going to show you some strategies to look at to check the companies that you own that pay a dividend. You want to make sure that, hey, do I have a chance that they're going to continue paying this dividend based on their financial statements, and whether or not they're going to be able to raise it in the future. All right. This is Uncle Pete. I'll see you in the next video.